Diamond, in the requirement number A, you are to distinguish between mutually exclusive investments and the independent investments. So this is a this is 3 marks, and there is a bonus one for that matter. But if you don't know, you don't know, no matter how simple it is. So you have to explain what is mutually exclusive investment, then what is independent investment. To answer this, of course, we have done this when I was explaining the concept of NPV. All right. So what do you understand by mutually exclusive investments? A mutually exclusive investment is a competing investment in which the acceptance of one will preclude the acceptance of the other. For example, if investment A and B are mutually exclusive, the acceptance of investment A will mean the rejection of investment B and vice versa. That answers that one. Then you can say, on the flip side, independent investment is a standalone investment that may be accepted or rejected based on its own merit. For example, if a project produces a positive NPV, it will be accepted. But if otherwise, it will be rejected. You have answered that one. 3 marks, you pocket it. Move to the next one. Number B, why is investment decision important to organizations, and what techniques can be used to ensure that optimal investments are undertaken by firms? I want you to answer this question. I won't say it. I want you to answer it. We'll be saying it from day one, right from the period we started cost of capital till last week. We mentioned that particular thing. So I need one of you to, if you know it, please raise your hand. We have just 1 minute to answer this. What do you understand by why is investing decision important? Yes, who wants to help us? Who is there to help us? If you know it, raise your hand, please. Why is investing decision important? Going. I will call name. If there is no volunteer, I will call name. We don't have time. Tony. Anthony. You are the first on the list. Tell us, what do you mean by why is investing decision important? Tony. Okay. Diamond, you are next on the list. Why is investing decision important? Like I said, it's something that we say almost every time we meet. Yes, Diamond? Or is it that you guys cannot hear me?
I can hear you. I can hear you.
Because it comes to question, everybody is silent. Oh yeah, Diamond, talk to us. Just try.
I would say investment decisions are important for strategic purposes.
For strategic purposes, okay? I will give you 1/10. Yeah, yes. Tilisa.
Yes,
are
sir.
you there? Yes, talk to me. Why is investing decision important?
Investment decision is important because in every investment, we must to conduct an appraisal, because an investment aim and objective of investment is to create wealth or to make wealth for the investors, return on their capital. So you have to make a decision to know which one is better to invest or which one that you will assess not to invest in. So it's an investment appraisal. When after appraisal, you make a decision to accept or to reject that one, the one that is not acceptable or the one that is not going to be profitable for the organization or for the firm.
Okay. Thank you, Mr. Tilisa. Yes, I will give you 6/10. You tried. In fact, I will give you 7/10. You tried. All right.
Thank you.
Because of time. It's something we do almost. There's no day we meet that I don't mention it. In finance, there are three principal decision areas. We have investing decision, dividend decision, as well as a financing decision. The essence of carrying out investing decision is to ascertain the financial viability of the investment or of the project using relevant investment appraisal techniques. That is the main reason. Like Mr. Atilisa said, you can't just say because you have so much money, just commit it on a project. You want to know whether the investment is financially viable, whether you can commit your limited scarce financial resources. As a result of that, you need to evaluate. Why are you evaluating? In order to determine the financial viability of the project or of the investment. So to answer this particular question, examiner is asking you, why is investing decision important to organizations? And what techniques can be used to ensure that optimal investments optimal investments are undertaken by firms. So to answer this, investing decision is important in order to ascertain its financial viability using relevant investment appraisal techniques. All right. So examiner is asking you which techniques can be used. The techniques that can be used to ascertain the financial viability of a project include the net present value, the internal rate of return, the modified internal rate of return, the adjusted present value, the payback period, the accounting, whatever the techniques, you can just mention few of them, like 3. You are good to go. That's it. That answers that one. You pocket it. 3 months, put it in your pockets. Move to number C. What is project payback period? So in this case, examiner is asking you to calculate payback period. How do you then calculate payback period? Remember, during our analysis, during the discussion of the concept, we said that payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow. Payback period is a measure of liquidity, that is, how quick can the project pay back the invested capital. All right. So, and I told you when you want to calculate payback period, there are 2 different ways you can do that, depending on the nature of the cash inflow. If you are given a constant cash inflow, then payback period will be calculated as the ratio of cash outflow to constant cash inflow. But when you are given irregular cash inflow, that is, the cash inflow for each year are different. In that case, you cannot use the formula. You have to use the tabular method. Okay. So if that is the case, you want to calculate, and of course, we also discuss the decision rule, but we are coming to that because it's one of the requirements so that we move faster. Now, I want to calculate payback period. How do I calculate payback period in this question? First thing first, you need to go out and bring out all the variables that you need to calculate your payback period. Of course, whenever you want to calculate payback period, you need cash flow. Okay, you need cash inflow as well as a cash outflow. All right, those are the basic 2 things that you need. However, as far as this question is concerned, because we also have to calculate NPV and then internal rate of return, let's bring out the variables that we have in the question. So let me stop sharing this and move to the working notes. But at your end, please open up the material so that you can follow through. Okay, so let's go back there. So we are going to read from the first page of the question. Let's go there together. Yes. True Talk Nigeria Limited is a fast-growing profitability company. The company is based in Lagos and has just won a contract to supply gas to the State Electricity Board. In this regard, the company plans to commission a 35-kilometer pipeline at a cost of 260 million naira. That 260 million naira is the initial outlay. So put it down somewhere. So, of course, your main solution should, it is expected that your main calculation will come on the first page. The payback period, all those number A, number B, number C to E requirements, all right? But however, as far as this class is concerned, so let's bring out the variables. I will say solution to illustration 1, true talk. Okay. Don't let me do that. That's the page. What page is that? That's page 45. Okay. So let's bring out the variables first. Please, on the day of your exam, don't do that. The variable should, whatever the calculation, whatever workings that you want to do should come last, should be on the last thing, on the last page. So you need to estimate what pages, how many pages will be sufficient to answer requirement number A, B, C, D, and E. You can estimate like 3 pages, depending on what you want to do, or 4 pages. Then you go and do your working somewhere, all right, making it the 5th one or the 4th one. But for the purpose of this class, I'll just come here, initial outlay. It's important you write out the variables that you need, especially in this kind of a question that is not, there's no much story. All right, so this is 260 million. That's the initial outlay. Go back to the question again. You also told that the pipeline, when installed, will carry the gas to an agreed location under the control of the State Electricity Board, SCB. With all these arrangements in place, it is expected that the sales of the company will increase from the present 360 million to about 1.1 billion. The fact that the sales value increased from 360 to 1.1 billion does not tell me that that is the sales value, because your sales value must be per annum. The examiner has not given me the sales value per annum, so I'll move to the next paragraph. The anticipated revenue from sales to the State Electricity Board is expected to be 120 million naira per annum. So SEB sales revenue is 120 million per annum. So let's indicate that revenue. As far as this question is concerned, there are 2 sources of revenue. One from State Electricity Board, which is equal to 120 million per annum. Okay. Then we're also told that apart from this contract, the pipeline could also be used to transport liquefied natural gas to other willing customers in the suburb. The sales from this source are put at 80 million naira per annum. So there's another revenue there, 80 million. So from LNG, 80 million naira per annum. Okay. Next, the management of True Talk Nigeria Limited considered the useful life of the pipeline to be 20 years. Okay, we have useful life to be 20 years. So in this case, the total revenue is 200 million per annum. This is total revenue. 200 million naira per annum. Move on from there. Okay. We are told that useful life is 20 years. Okay. Next item. The management of True Talk Nigeria Limited considers the useful life, okay, 20 years. The financial manager estimates a profit to sales ratio of 20% per annum for the first 12 years and 17% per annum for the remaining life of the project. Who can tell us what's another name for profit to sales ratio? What other name can we call profit to sales ratio? If you know it, raise your hand, please. Profit to sales ratio.
Profit margin.
Profit margin. Okay. Yes. Who again? There's a specific word I want you to. Pardon?
Contribution.
Contribution what?
Margin.
Contribution margin ratio. Remember when you did cost volume profit analysis? Another name you can call profit volume ratio is contribution margin ratio. So the percentage of contribution to sales is the same thing as profit to sales ratio. All right. So examiner has given us profit to sales ratio of 20% for the first 12 years and then 17% for the remaining years. So what are you supposed to do here? You need to multiply 20% on the 200 million revenue. Okay, so you can say contribution. So for years 1 to 12 equal to 20% multiplied by the revenue. All right. This is, let me do it this way. Profit to sales ratio. Okay. All right. So multiply by 200 million. This is equal to 40 million naira per annum for the next 12 years. Year 1 to 12, it will be constant at 40 million. Then for years 13 to 20, to be 17% multiplied by total revenue of 200 equal to 17 million per annum. Okay, let me rewrite that. 40 million per annum. And 70 million per annum. Okay. What else? Let's go back to the question again.
4 million.
No, that
Pardon?
17 is not correct.
34 million.
Oh, error of mind. Don't mind me. I wanted to write something else. Thank you for the observation. 34 million. Okay. Thank you. Next. The project is not likely to have any salvage value. That is, the scrap value will be equal to 0. The Truth Truck Nigeria Limited is located in a remote area, hence will enjoy exemption from tax, which means that our cash flow will not be impacted with tax. The company's cost of capital is 15%. That's it. So here we have cost of capital. Okay, so be 15%. So that's it. These are the variables that we need to do justice to the question. So let's solve now. So we want to calculate payback period. Let me put the name of the company so that you'll be able to understand. True Top Nigeria Limited. Okay. So I want to calculate payback period. Requirement number C. Calculating payback period. So how do you calculate payback period? So like I said, the payback period will be computed depending on the nature of the cash inflow. If you have a constant cash inflow, then payback period will be calculated as cash outflow divided by cash inflow, constant cash inflow. So when you look at the cash flow given to us, the cash outflow is 260 million. Initial outlay is 260 million. The cash inflow is constant for years 1 to 12 at 40,000 naira, years 13 to 20 at 34 million naira per annum. Okay, so if this is the case, our cash flow of years 1 to 12 is constant at 40 million. How many, if you multiply 12 years, if you multiply 12 years by 40 million naira, that will give us 480 million, which means that the initial outlay of 260 million is within the 480 million, which means that we are going to recover the invested capital within the first 12 years. I will take it again. The initial outlay is 260 million naira. Because our cash inflow is constant at 40 million naira for the first 12 years. So I want to know whether if I multiply that 40 million by 12, that will give me 480. I want to know if the initial outlay, if the cash inflow of the first 12 years is going to cover the initial outlay, which of course it did, because when you multiply 40 million by 12 years, that will give you 480. 260 million is within 400, is within the 480 million. Therefore, I can use formula to calculate my payback period. So I will then come here, payback period equal to cash outflow over constant cash inflow. Everything must be expressed in years. So payback period will then be equal to the cash outflow is 260 million over constant cash inflow of 40 million per annum. All right, so this will give us 6.5 years. Okay, this will give us 6.5 years. So which means that this project will pay back within the next 7 years. Within 7 years, the company will recover the invested capital of 260 million within 7 years. That is that. If you want to use primary school, as an average student may get confused as to how to calculate this. You can't be doing that on the day of your exam. Remember, the useful life of this project is 20 years. How could you be using that kind of a thing? You need to think outside the box. What do you need to do? Say, for example, as an average student, using the tabular method, you create a column for year, create a column for cash flow, then you create a column for balance to recover the amounts. Year 0, year 1, year 2, year 3. Don't go and be doing this on the day of your exam. It's a waste of time. Year 4, year 5, year 6, year 7, okay, on and on like that until you get to year 12. Then you now continue year 13, year 14, you continue like that until you get to year 20. I can't be doing this on the day of exam. You don't have time. So here will be 260, the same 260. Our cash inflow is constant for the first 12 years at 40 million. So you say 40, 40, 40, 40, 40. Even when you are doing this kind of a thing on the day of your exam, something should be telling you, your body should be telling you that something is wrong somewhere. This is not, this is not right. Because an examiner cannot put you through all this stress now, this kind of a thing. So in year 13 is 34. 34, 34, you continue until you get to year 20, 34. So if I want to get to my payback period now, I would then say 260 minus 40. That would be 220. Okay, 220 after year 1. Then 220 minus 40, 180. 180 minus 40, 140. 140 minus 40, 100. 100 minus 40, 60. 60 minus 40, 20. When you get to a point when the outstanding balance is lower than is less than the next cash inflow, you put a dash, then you compute your payback period. In this case, I would then say payback period equal to how many years have I recovered? I've recovered 1, 2, 3, 4, 5, 6. I would then say 6 plus what is the outstanding balance? Outstanding balance is 20 over then the next cash inflow of 40. That will give you the same thing as 6.5 years. You can't be doing this on the day of your exam. You are still doing this. I'll move to the next question. Please don't do this. Huh? So I only do this just to show you, for those of you that may be confused. All right. Okay, then. So let's move to the next one. Let me know if you have any question. All right. Number D. Yes, talk to me.
So please, what about if we use an annuity formula? Will it still work?
If you use what?
Annuity formula and use the cost of capital to discount it first before you do the payback.
You don't do that for payback. You don't need to. You don't discount your cash flow before you calculate payback. All right. For your traditional payback period, you don't discount cash flow. You use your cash flow, your normal cash flow the way it is. You only discount your cash flow if you want to calculate discounted payback period. So examiner did not ask you to calculate discounted payback. Okay? Is it clear?
Yes, sir. Thank you.
You're welcome. So number D, advise True Talk Nigeria Limited given reasons as to the acceptability of the project based on the payback period criteria. I need you to answer this. Yes, who will help us? How do we advise True Talk? How do we advise True Talk?
Is it based on what we just calculated?
Yes, based on the payback period.
Okay, since it takes 6.5 years to get back the cost of the initial or the cost that was initially invested, then we can say that the project is viable, because apart from getting the cost, there will still be revenue that will be generated. So it's viable to key into this project.
Okay, what about the acceptability? Examiner is asking you to advise True Talk Nigeria Limited given reasons as to the acceptability of the project based on the payback period criteria. Should we accept the project?
Yes, we should accept the project.
Okay. I know.
Yes, sir.
Yes, talk to me.
So I would say no, because there was no management predetermined time payback for the project.
Why? Why do you need management predetermined payback period?
Because it is benchmark on management predetermined period.
Okay.
If you're not given, you cannot accept it.
All right. That means you have been reading your books. All right. It's very important. You know, I purposely threw that question to you. I want to know if you know what you are doing. All right. Remember when I was explaining payback period, I mentioned to you that there are decision rules for payback period. For independent projects, you accept if payback period is shorter or equal to management predetermined payback period. For mutually exclusive projects, accept any project with a shorter payback period, provided it is equal to or shorter than management predetermined payback period. So as far as this question is concerned, the management predetermined payback period is not given to you. Then what is the basis of the acceptability of the project? And I told you when I was giving you the notes, I said, note the following. If I said that the calculated payback period must be benchmarked against the management intended or targeted payback period. If the management predetermined payback period is not given, there will be no basis for the acceptability of the project because you need to benchmark it. In this question, we are not given. Therefore, how do you then answer the number D requirement? what you are going to say is that the project will pay back the invested capital of 260 million naira within 7 years. That is 6.5 years, in the next 6.5 years. However, there is no basis for the acceptability of this project since the management targeted payback period is not given. No need for stories. Stop there. You have already told the examiner that this project will pay back within 7 years, but you cannot say the project should be accepted since you don't know what you are supposed to benchmark it against. You don't know it. You don't have it. So you cannot say the project should be accepted. All right. So that's that. Let's move to number E. Compute the project's
Hello,
NPV.
sir. Sorry. Hello, sir.
Yes, talk to me.
Like you know, there are years, year 1 to 12 and 13 to 20. How
Yes.
about if the payback is not up to this and 260? So we'll still do for the 13 to 20, right?
Of course, in that case, you have to use tabular method. What you are saying is that what if the initial outlay of 260 is more than the cash inflow of year 1 to 12? Let's say, for example, the cash inflow of year 1 to 12 is 240 million. Meanwhile, your initial outlay is 260 million. That means the first 12 years cash flow cannot cover the initial outlay. In that case, you use tabular method. You cannot use formula for that. Do you get?
Yes, sir. Yes, sir.
So in that case, you have to use table. So you list it year 1 to 12, 40 million. Then year 13, 34 million. Continue like that. All right. So in that, you have to finish everything. Just list it 1 to 20. But I doubt if examiner give it to you, it's what it is. So move on. Number E, we have to compute NPV as well as the internal rate of return. So first thing first, we start from NPV. Number E, Roman figure 1, E1. Calculating NPV. So in this case, how do you compute your NPV? There is no multiple variables here. So in this case, just come here. I'll create a column for year. Okay. Description of items, cash flow, discount factor at 15% cost of capital, then the present value. Our figures are in million. Okay. So year 0, year 1 to 12, then year 13 to 20. Here is initial outlay of 260 million. $260 million multiplied by 1, that's 260. Then cash flows or contribution, just call it contribution. Here is 40 million per annum, 34 million per annum. So we need to go and calculate annuity factor of year 1 to 12, then annuity factor of year 13 to 20. Okay. Let me see. Okay, no space there. No space there. So annuity factor, payback period will be there. Let's put our annuity factor here. Annuity factor AF. You know, annuity factor is calculated as 1 minus 1 plus R raised to power minus N divided by R. So in this case, the company's cost of capital is 15%. So you calculate annuity factors of years, because of space, let me push it there. Years 1 to 12 will be calculated as 1 minus 1 plus 1.15 Okay, 1.15 raised to power minus 12. N is 12. Then divided by 0.15 equal. So what do you have there? Bring out your calculator. Okay, you say 1.15 raised to power.
4206.
Pardon?
5.4206.
5.421. Okay, 5.421. This is at 15%. Okay, so because we are still going to calculate internal rate of return, so we use the other side for whatever percentage you want to assume. Then, now, we want to calculate annuity factor of years 13 to 20. How are we going to calculate annuity factors of year 13 to 20? What you are supposed to do is to calculate annuity factor of year 1 to 20 first. So I will come here, years 1 to 20, which is 1 minus 1.15 raised to power minus 20 divided by 0.15. Give it to me. What do you have there? Yes. Annuity factors of years 1 to 20. What do you have?
6.259.
6.259. So to now get the annuity factor of years 13 to 20, you are going to less annuity factor of year 1 to 20, which is 6.259 minus annuity factor of years 1 to 12, which is 5.421. So give it to me. What do you have there?
0.838.
0.838.
0.838. So that is how to calculate annuity factor of years in between years. That is from year 13 to 20. With this, I can then go up there. Here is 5.421, 0.838. So multiply with 40. What do you get? Let's keep moving. What do you have?
216.84.
216.84.
216. That's 217.
217.
Then 34 multiplied by 0.838.
28.4.
28.1.
28 point, that's 28. So 415 minus 260 will give us, that's a 15
Yeah,
negative.
if
So
you're
we're
rounding up, then it should be 29.
29. Are you sure?
Yes. That's 28.49. True.
28.49, that's 28. 4 is not up to 5.
492.
It's not up to 5. That 4, the first, after the decimal point, the first letter, the first figure after the decimal point must be equal to 5 or more than 5. If it is less than 5, you cannot round it. Okay? All right. So that's the NPV. Of course, if examiner asks you to advise on the basis of NPV, you see that the project is not viable because it produced a negative NPV. So let's calculate internal rate of return. high. Calculating internal rate of return. So to calculate internal rate of return, what are you supposed to do? You are going to assume two discount rates that will produce two opposing NPV. One discount rate will produce a positive NPV. Another discount rate will produce a negative NPV. Then you calculate internal rate of return using the IRR formula. That's it. As far as this question is concerned, since we have calculated NPV negative using 15%, Let's assume a lower discount rate and see if that lower discount rate will produce a positive NPV. Once we have a positive NPV, then we can assume this 15% cost of capital as our second discount rate. Okay? So come here, assume 10%. Let's see what 10% will produce. Item, cash flow, discount factor at 10%, then present value. A wise student should have gone ahead somewhere and do the annuity factor at 10% before I ask you. All right, do annuity factor of year 1 to 12, annuity factor of year 1 to 20, all those things, so that before I get there, once I ask you, give it to me immediately. That will be faster. Then 13 to 20. All right, initial outlay, contribution 260, 40, 34, 1, 260. So what's the annuity factor of years 1 to 12?
6.814.
6.814. 6.814. Annuity factor of year 13 to 20. Yeah. Here is at 10%.
8.5.
6.814. Then years 1 to 20 is what?
8.514.
8.514. So what's the difference? That's
1.701.
700. There's no 1 there because this is 4, the other one is also 4. So that's 1.7. The difference is 1.7.
I did
All
not
right.
approximate.
You don't need, so you know you have approximated to 6.814.
No, I did not approximate. You are right. You are right, sir.
Yeah,
I did not approximate.
Okay, so 6.814, then 1.7. Okay, 1.7. So multiply for me, please. 40 multiplied by 6.814.
273.
273. 273. Then 34 multiplied by 1.7.
58.
58.
58 plus 273 minus 260.
Positive 71.
Pardon?
71 positive.
71 positive. So we assume 10%. We got a positive NPV of 71. In that case, we are going to assume the second discount rate to be 15%, which produce 15 NPV negative. So with this, I can then calculate the internal rate of return, IRR, equal to lower discount rates plus NPV of the lower discount rates over NPV of the lower discount rate plus NPV of the higher discount rates multiplied by higher discount rates minus lower discount rates. So in this case, internal rate of return, we assume 10 and 15%. 10% is lower plus NPV of that 10 is 71 over 71 plus NPV of the higher discount rate, which is 15. So higher discount rate of 15 minus lower discount rate of 10. Final answer, what do you get? What is your IRR? 71 divided by 86 equal, multiply by difference between 15 and 10, which is 5, equal, plus 10, equal. That's 14 point what?
14.13.
14.13%. Approximately, internal rate of return is 14%. IRR is approximately 14%. You know, when I was explaining the concept, I mentioned that where you have independent projects, the decision of NPV will be the same thing as decision of internal rate of return. We will notice that if you want to advise the company on the basis of NPV, you notice that the NPV is negative, which means this project is not viable. Also, if you want to advise on the basis of internal rate of return, the internal rate of return calculated of 14% is less than the company cost of capital of 15%, which means the project is also not viable. So under independent project, decision of NPV will always be the same thing as the decision of the internal rate of return. Okay, so that's end of the question. Let me know if you have any question for me before we move to the next scenario. Okay? Any question? So if not, I'll stop sharing this, then move to the main question. Okay. Let's have illustration number, let me see. Let's have illustration number 3. So after this, that means we have 2 more illustrations. So let's have this illustration number 3 first. Yep. Who will help us to read? Yes. Diamond, read again.
Okay. Washington PLC is considering a project whether or not to commercialize an innovative muscle toning device (MTD) that will be used in the treatment of sporting injuries. It is expected that the commercial life of the MTD will be 4 years, after which technological advances will bring more sophisticated devices to the market, and the sales of MTD will fall to virtually zero. 8 million naira has been spent in developing and testing the device over the past year. Initial market research has been conducted at a cost of 2.5 million naira and is due to be paid shortly. Information on future returns from the investment has been forecast to be as follows. Should I read it? Okay.
No,
Selling
next one.
Selling price inflation rate and fixed cost inflation are expected to be 5% per year, and variable cost inflation is expected to be 4% per year. Fixed costs represent incremental fixed production overheads, which are wholly attributable to the project. The production equipment for the new device would cost 120 million naira, and an additional initial investment of 20 million naira would be needed for working capital. The equipment is expected to be sold at the end of 4 years for 10 million naira when the production and sales cease. The average general level of inflation is expected to be 3% per year, and working capital would experience inflation of this level. Capital allowances (tax allowable depreciation) of 25% on a reducing balance basis could be claimed on the cost of equipment. Profit tax of 30% per year will be payable 1 year in arrears. A balancing allowance will be claimed in the 4th year of operation. Washington PLC has a real cost of capital of 7.8%. You're required to A. Calculate NPV, IRR, and discounted payback period, 22 marks. B. On the basis of NPV, advise if the project should be considered, 3 marks. C. What are your assumptions on the calculations above, 5 marks, total 30 marks.
Thank you, Diamond. Yes, that is the question. Number A, you are to calculate NPV, IRR, and then discounted payback period. So without wasting time, Let's stop sharing and move to the working note quickly. So we want to calculate NPV. All right. So you can see in this question, you have sales value, you have variable cost, you have working capital, you have incremental fixed cost, you have scrap value, you have initial outlay, you have working capital, you have inflation and taxation. This is a multiple, you have been given multiple variables. So in this case, you cannot use the other format. You have to use the columnar format to compute your NPV. So to do this, first thing first, you need to design, you need to outline your table, all right? What do you want? The name of this company is Washington. So you start from, okay, this is solution to, what's wrong with you? Solution to question, what's now? To question number 3, page, what page is that? That should be page 30 or 47. Yes, page 46. 46, Washington, PLC. All right. So examiner is asking you to compute NPV. So number A, Roman figure 1, calculating net present value. Please, on the day of your exam, you're going to be writing NPV. You need to write it out in full. Our figures, you can put your figures in million or in thousands, depending on however you want to do it. Just make sure that you are consistent. All right. So I will then go back to the question. What's the useful life of the project? According to the question, the project's useful life is 4 years. Then, if project's useful life is 4 years, I need to go back to the section of the question where taxation is mentioned. I want to know how I'm going to pay tax. Is tax going to be paid in the current year the profit is earned, or 1 year in arrears? According to the question, you are told that profit tax of 30% per year will be payable 1 year in arrears. So that means because of tax purposes, the table will extend by additional 1 year. So I need to do for year 0, year 1, year 2, year 3, 4, then 5. Okay. Lastly, I need to create a column for working, if need be, if you want to. Otherwise, you can just put it by the side. Okay. So in the format I gave to you, the first item is your sales value. See, there's no need for you to be reading all over again. You already know the format whenever you want to calculate NPV. Go straight to your workings. All right, go to the question. Are you given selling price? If yes, is there any inflation rate? Then inflate. If there's no inflation rate, just multiply the selling price with the number of units sold. But if you have selling price and inflation, inflate the selling price, multiply with number of units sold, then you come and post. So you don't need to waste time at all. So let's go to the question together. I want to determine sales. I don't need to be reading all over again, since I already know in the question that, okay, I have my performance and I'm given sales value, I'm given selling price. Now, I want to calculate sales value. According to the question, you are told that selling price in current price terms, 2,000, 2,200, 1,615. So examiner has told you that selling price is in current value terms, which means that this is real cash flow. If the cash flow given to you are real cash flow, so you want to convert it to money cash flow. So if that is the case, I need to go and do my working. The first page will be for my NPV, then internal rate of return, discounted payback period. So that would be for the first 2 pages. Then, all right, so I can start my working from here. just in case. Let me start my working from here. So the first item I will do is to indicate the year. Year 1, year 2, year 3. Let me give space. Year 1, year 2, 3, then year 4. Demand in units. What was the first year unit given?
20,000.
20,000. The second year?
70,000.
Third year?
125,000.
And then the final year?
20,000.
20,000. Okay. So working number 1. I want to determine sales value. Before you can get the sales value, you need to first of all determine the selling price. So I will then come a selling price. Selling price for the first year is 2,000. Okay, in current value terms, 2,200. Then after 2,200, we also have 16, then 15. 1615. So we need to inflate these prices. Inflation. Examiner has told us that inflation on selling price is 5%. Therefore, I would then say 1.05, 1.05, 1.05, 1.05. You remember when I was giving you notes, on inflation, under the general rules, I told you that note the following. When cash flows are stated in first year prices or year 1 prices, inflation should start from year 2. Number B, when cash flow are stated in today's prices, year 0 prices, or current value time, inflation should start from year 1. So the selling price given to us in this question is in current value terms. Therefore, we should start inflating from year 1. I would then say raised to power 1, raised to power 2, raised to power 3, raised to power 4. Okay. Let's say this is A, this is B. No, not that one. This is B. This is an inflated selling price. Okay. Then total sales. Sales in thousands will then be equal to A times B. So let's multiply. So you are going to say 1.05 raised to power 1 equal, multiply by 2,000 equal 21. Here is 21. Then 1.02 raised to power 2 equal, multiply by 2,200. That's 2289.
2426.
Oh, thank God. I'm even my calculator is even showing error. I have 1 point. Okay, 2426. 2426. Okay. The next one, please.
Hello, sir.
Yes.
1852.
I can't find
1853.
where the question is saying the sales value is given at current value, because according to the rules you gave to us, once the sales value is given at the year 1, that means inflation will start in year 2. So I don't.
Are you with the question?
Yes, sir.
So in front of, do you know, have you seen where you are given the selling price?
Yes.
So read it, read it. What do you have there? Read it. Read the selling price. I want to hear.
The selling price for year 1, selling price in current price. Okay. In
So are you
current
okay?
price terms.
Are you
Yeah,
okay? Have
okay.
you seen it now?
Yes, sir. Yes, sir. Thank
Okay.
you.
So the next one, year 4, please. Year 4,
1823.
1823. So let's multiply with the number of units sold. 1 multiplied by 20,000. What do you have there? You pick it one by one.
42 million.
42 million.
42,000 figures are in thousand. Then the second year, somebody should give me the fourth year. Yes,
169
169. Okay.
820.
169,820.
231 500. Year 3.
231 500. Year 4,
460 million.
460. Okay, that's it. So let's go and post 42 169 820. Year 1, 42,000 169 820 231 500. Then 36 words. 460, right? Am I correct? Year 4. Is year 4 correct? For 36 460. Let me check
Yes, sir.
again. Yes, that's it. So I'm done with sales value. I will do the same thing as variable cost. Variable cost. Variable cost for the first year is how much? According to the question, 900, 1,000, then 1020. 900 is the first year, 1,000 is the second year, 1020 third, 1020 for the fourth year. Then inflation on, what's the inflation rate for variable cost? What's the inflation rate?
4%.
4%. Okay. Therefore, 1.04 raised to power 1, 1.04 raised to power 2, 1.04 raised to power 3, 1.04 raised to power 4. So 1.04 multiplied by 900. What do you have?
936.
936. Okay. 936. 1193. Yes.
10812.
1081.
2.
1082. Next.
1147.
1147. So that's number C. This is the inflated variable cost. So the total variable cost in thousands will then be equal to A times C multiply with the units produced. What do you get? 936 multiplied by 20,000.
842,400.
18720.
18
720.
720. Next one. 70 multiplied by 1082.
75 740.
75 740. 125 multiplied by 1147.
143 375.
143 375. 20 multiplied by 1193.
23860.
23860. So we have calculated the variable cost. Let's go and post 18,720. First year is 18,720. Variable cost 18,720. Then the second year is what?
75,740.
75,740. Next.
143,375.
143,375. Year 4.
23,860.
33860. Okay, so let's go back to the question to identify other relevant cash flow. In the table, you also have fixed cost in current price, 10 million naira per annum. See, when I was explaining the concept, I told you there are 3 different ways the examiner can test you on fixed cost. If you are given fixed cost and there is no further information, no additional information, that fixed cost is irrelevant. Number 2, examiner can give you fixed cost, including depreciation. That fixed cost is also irrelevant. However, you need to calculate annual depreciation and less from the fixed cost. Then number 3, you can be given fixed cost excluding depreciation. The fixed cost that excludes depreciation is relevant. You need to account for it. However, in this question, examiner told you that fixed cost represents incremental fixed production overhead, which are only attributable to the project. Remember, during my explanation of relevant cash flow, one of the line items that we discuss as a relevant cash flow is incremental fixed cost. So incremental fixed cost, direct, attributable, specific fixed costs are all relevant cash flow that we should consider. Since examiner has told us that the fixed cost of 10 million naira is incremental fixed production overhead, that means it is relevant. We have to account for it. Okay, we need to account for it. Therefore, let's go and do that. So I will come here, fixed cost. Just say incremental. You can call it incremental or attributable fixed cost, whatever the examiner has used. Okay. So the inflation, in this case, I don't need to go and do working for inflation because inflation is not related to it's not related to, it's not related to number of units. So I can decide to ignore working. I'll just do it straight away. So I can put the inflation rate. The inflation rate for fixed cost is 5%. Let me reduce the font so that I can occupy that. Incremental fixed cost at 5%. Okay, so the first year, the first fixed cost given to all is 10 million, all throughout 10 million. So which is 10,000. So I don't need to do working like I said. I will just say 10,000 multiplied by the inflation rate of 1.05 equal, that's 10,500. Here is 10,500. 10,500 multiplied by 1.05 equal 11,025. 11,025. What you have in your calculator multiplied by 1.05 multiplied by 1.05 equal 11,576. Here is 11,576. What you have in your calculator multiplied by 1.05 multiplied by 1.05 equal, that's 12,155. 12,155. 12,155. That's it. That's it. I'm done with incremental fixed cost. What else? Now, move to the next paragraph. The production equipment for the new device will cost 120 million naira. That 120 million naira is the initial outlay, and an additional initial investment of 20 million naira would be needed for working capital. Okay, we are coming back to that. Now, when you go to the first paragraph of the question, examiner has given you some cash flows. In the first paragraph, you are told that 8 million naira has been spent in developing and testing the device over the past year. That 8 million naira, is it relevant or irrelevant? If you know it, raise your hand. 8 million naira, relevant or irrelevant?
Irrelevant, sir.
Why is it not relevant?
Because there's some cost.
It's a sunk cost. You are correct. Initial market research has been conducted at a cost of 2.5 million naira, and this is due to be paid shortly. That 2.5 million naira market research cost, relevant or irrelevant?
Irrelevant.
Why?
It's also a some cost.
It's a sunk cost. Yes, you are correct. So when you are done with your calculation, even the examiner did not ask you to state your assumption. Okay, it's even there in number C. So you need to comment on that. So those cash flows, 8 million and 2.5 million naira, are irrelevant. You ignore it. So if that is the case, let's get our profits. So let's find the profits. So what's the profit for the first year? Somebody should be doing year 4, year 3, year 2, so that quickly we can finish this up. Yes? Are we still
12,780.
12,780? Year 2,
Yeah, 4,445.
445. 445. Okay. Year 2, year 3?
Year 2,
Yep.
83,055.
33053.
83.
83. Oh, okay.
Yes, sir.
83055.
Yes, sir.
Then year 3,
76549.
76549. Okay, this represents the profit. So we are following a format. Immediately after profit, you are supposed to pay tax. Tax rate is 30% according to the question. And we are told that tax is paid 1 year in arrears. That is, the profit of the first year will be taxed in the second year. The profit of the second year will be taxed in the third year, on and on. So what's the profit? 30% of 12,780. What do you have there? Yes,
3834.
3834. Okay. 30% of 83,055.
24917.
917. 30% of 76,549.
22965.
22965. Okay. 30% of 445.
134.
Sorry, please, for
134.
year 4, I don't think it's correct though.
What do you have?
I have minus 955.
955. Year 4.
Minus 955.
Year 4 profits.
Yes.
It can be. Do your calculation again.
The
Is
last
that
figure there is 12,155, right?
yes? 36,460 minus 33480 minus 33860 minus 12,155 is 445. All right. So immediately after your tax liability, you are supposed to claim your capital allowance. So I will say tax saved based on the format. Tax saved on capital allowance. Your capital allowance must follow the pattern of your tax liability. Therefore, let's go and work out the capital allowance. Working number 3. So this space cannot occupy it. So number 3, tax saved.
Excuse me, sir.
Yes.
For that year 5 is
Yeah.
9,555.
9
So
what?
9,555. If that is 33, is sorry, where's that figure again? The variable cost is that
Yes.
23,860, right?
143,375.
No, she's talking
No,
about
I
the
mean
variable
variable cost.
costs at
Variable cost for
1.2.
year 4.
For year 4.
Is
Year
it
4 is,
It's
23 or
23.
33?
hold on, 36, 460 is the, sorry, that's the sales value.
I mean the variable.
23,860 variable cost. 23,860.
Okay,
Oh, okay, that one
correct
is,
then.
I wrote 33 instead of 23.
Yeah.
Okay, maybe that's why she's having a
Yeah, that was
different,
where she got it from.
this is 23. Okay, so the 445 is correct. Now, let's calculate her saved on capital allowance. Okay, that's saved on capital allowance. So there's a format. Create a column for year, the narration of the items, the cost of the assets, then tax saved at the company tax rate of 30%. Our figures are in thousands. Okay, year 0. The cost of the asset is 120 million naira. Then in year 1, in this question, the examiner did not give us initial allowance. Therefore, you are going to ignore it. So you only calculate for annual allowance. Annual allowance, the capital allowance rate given to all is 25%. Therefore, what's 25% of 120,000?
30,000.
That's 30 minus 120. We are told that our capital allowance is on a reducing balance basis. So here is 90,000. This represents tax rated down value at the end of year 1. I will move to year 2. Annual allowance at 25% of 90,000. What do you get? What?
22,500.
500.
2,500 minus 90,000 will give us 67,500. This is tax rated down value at the end of year 2. We then move to year 3. Annual allowance at 25% of 67,500. What you get? 18 what?
16,875.
16,875. 16,875 minus 67,500.
50,625.
50,
625 minus 50,625.
625. So this is the tax rated down value at the end of year 3. Remember, the useful life of this project is 4 years. So in the final year, year 4 is the final year. So you are going to compare the tax rated down value from year 3 with the sales proceed. All right. So the scrap value, according to the question, the scrap value from this asset is 10,000. We are told that the asset will be disposed of at 10 million naira. Okay, so the difference between these will give us 40,625.
So
That will be
the year
year
of
4.
the asset is 4 years now.
What did I just say? Did I say something different? So what do we call this 40,625?
Balancing
What's
charge.
balancing?
Charge.
It's not a balancing charge. It is balancing allowance. When the
Allowance.
tax rated down value from the preceding year is greater than the sales proceed, it is called balancing allowance. But when the tax return value from the preceding year is less than the sales proceed, it is called balancing charge. So this particular one is balancing allowance. So if I want to use capital allowance to reduce tax liability, I will select this, and this. Before I calculate my tax liability, I will first of all deduct my capital allowance. I will have my taxable profit. Then I will now multiply tax rate on it. But we can't do that. We are using tax saved on capital allowance. Therefore, to calculate my tax saved, you need to multiply the company tax rate on the capital allowance for each year. So what's 30% of 30,000? This should be 9,000. 30% of 22,500 should be 6,750 or thereabout. Please confirm. Is it? 30% of 22,500. What do you have?
6750.
Okay. So what's 30% of 16,875?
5063.
5063.
63.
Then 30% of 40,625. 30% of 40,625.
12188.
188. So we reduce it to 187 because this will be over by 1 because of rounding. We have rounded this one. You also round this one. So when you add it up, supposed to give you 33,000. This will be 33,000. But if you don't round this one, it will be over by 1. So this represents the total tax saved. Total tax saved, TTS. So if you want to use formula to confirm that, total tax saved equal to the cost of the assets minus the scrap value multiplied by company tax rates. Okay, so the cost of the asset is 120,000 minus scrap value of 10,000 multiplied by 30%. So we should have the same thing as 33,000. Okay, so of course, we don't need this thing for anything. It's just to confirm that you have not overclaimed or underclaimed your capital allowance. That's the essence of that. Now that you have computed the capital allowance, then you need to go and post 9,650. So again, your tax saved on capital allowance must follow the pattern of your tax liability. Since your tax liability is in arrears, then your tax saved on capital allowance must also be in arrears. 6,750, 50, 63, then 12, 187. That's it. So after this, in our format, the next item will be the scrap value. Scrap value is 10 million naira at the end of the useful life. Useful life is 4 years. Please, you have to be very careful. The essence why you extend this one to the 5th year is because of the impact of tax. Don't go and put your scrap value in year 5. When you do that, that will be wrong because the useful life of the asset is 4 years. Yes, Wumi, talk to me.
Yes, sir. It's on the calculation of that tax saved that we calculated.
Yes.
So how do we know we are expected to get that 33,000? Because you said something like because of the impact of rounding figure that we are supposed to get 33,000.
And so first you see, this is what you are going to do before you put down the final figure. This last one that is 12,188. Before you put it down, you need to calculate your capital allowance. This is the total tax saved you are supposed to claim, which is 33,000. So if it's more than 33,000, you need to restrict the last figure to make it equal to 33,000. You can't overclaim your capital allowance. Yes, the exact capital allowance that this company is supposed to claim is 33,000. Okay? Because
Okay,
if
so
you
does
put,
it mean that we should have applied this last formula first?
of
So it
course
can
now,
guide us in what we are
of
calculating on.
course, you can't claim more than that.
Okay.
Yeah. So the next item is initial outlay based on the format. So here is initial outlay, which is 120,000. Okay. Then we have, according to the question, we're also given working capital. So let's go back to the question. How much is working capital? According to the question, you are told that an additional initial investment of 20 million naira will be needed for working capital. Okay, so if this is what you are given, that 20 million, no further information, what you are supposed to do is to recognize this 20 million naira in year 1. So we should be treated as cash outflow in year 0. At the end of the useful life, in year 4, you recover the 20 million naira. That's all you need to do. But examiner told you further on that same paragraph, the last sentence on the paragraph, you are told that the average general level of inflation is expected to be 3% per annum, and working capital would experience inflation at this level, meaning that working capital will increase by 3% per annum per year. So in this case, we need to go and do calculation for working capital. This would be incremental working capital. So come here, working number 4, working capital. So year 1, year 2, year 3, and then year 4. So you can create a column for total. All right, so the working capital given in year 1 is 20 million. So this working capital, we are given working capital of 20 million in the first year. So in this case, and you are now told that it will increase by 3% per annum. So what that simply means is that you need to calculate. I don't need to be doing primary school for this one. Let me just rewrite this one because of space. Working capital, WC. So you then come here, working capital at inflation rate of 3%. So the first year working capital is 20 million. So when you are given first year price, inflation should start from year 2. Simply 1.03 multiplied by 20. This will give you 20,000, then 20,600. 20,600 multiplied by 1.03. 2,600 multiplied by 1.03 equal 21,218. 21,218. 21,218 multiplied by 1.03.
21855.
That's 21855. 21855. Okay. So you can see that working capital has increased from 20 million in the first year to 21,855,000 in the fourth year. Therefore, remember the treatment of working capital. I said that if you are given a one-off working capital, it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. However, if you are given incremental working capital, it should be treated the same way as the one-off working capital, except that only the increment should be considered. You can see that working capital has increased from 20,000 to 21,855. So first thing first, you need to determine the incremental working capital. You then come here, incremental working capital. The first year working capital is 20,000. It has increased to 2,600 by 600. 2,600 has increased to 21,218 by 618. 21,218 has increased to 21,855 by 637. Please confirm. 637. Is it 637?
637, correct.
Okay. So when you add up everything, you should have the same thing as 21,855 because the highest working capital from 20 is 21,855. So if that is the case, all you need to do now is to go and post. But before you post, you can come in and say relevant here. Relevant here. The one that will call in year 1 should be treated as cash outflow in year 0. The one that will call in year 2 should be treated as cash outflow in year 1. The one that will call in year 3 should be treated as cash outflow in year 2. The one that will call in year 4 should be treated as cash outflow in year 3. At the end of the useful life, you recover the entire working capital. That's it. Let's go and post. Year 0 is 20,000. Year 1 is 600 negative. Then 618 negative. 637 negative. At the end of the useful life, year 4, you recover everything. 21,855. That's working number 4. This is working number 3. All right. So at this point, we need to determine the net cash flow. Let me write this one. This is 917. So let's determine the net cash flow, please. Here is 140,000. Yes. 12,780 minus 600. That's 12,180. Next one. Yes. 12,187 minus 134 equal 12,053. 12,053. Only me, I've done 3. Oh. I've never heard from you. Are you still there? 445 minus 2296. 965 or 963? 965. Let me confirm that number. Let me confirm the number, which is 76,549 multiplied by 0.3. That's 22,965. Okay, this is 5. Let me write it. Are we still together? Wumi?
Yes, sir, we are.
You are not
Year
giving me
4
figures.
is year 4 is minus
87,303.
7,457.
Pardon?
Year 4 minus 7,457.
Are you
7,
sure?
4.
I
It's
have
not, it can't be minus.
4398. I have 4398 for year 4.
40,
14398.
14,398. Somebody should confirm again.
14,398 is correct.
Okay. Year 2 and 3.
Yeah, 87,303.
87,
It can be confirmed though.
303. Yes.
57745.
57745. Okay. So this represents the net cash flow. So with this net cash flow, you can calculate NPV, IRR, payback
Sorry,
period.
87,603. Not 303,
603.
603.
Okay. So you can use any techniques to evaluate the project apart from the accounting rate of return. So if that is the case, the next thing we want to do now is to discount because we are calculating NPV, discount factor at, now, when you go back to the question, the cost of capital given to you is real cost of capital. You are told that Washington PLC has a real cost of capital of 7.8%. So because you have inflated your cash flows, you cannot use that 7.8 as your discount factor. So you need to go and calculate money cost of capital because the cash flow that we have are money cash flow. So you have to use money cash flow for money cost of capital, real cash flow for real cost of capital. So let's go and calculate money cost of capital. Working number 5. Let me put it working number 5. Money cost of capital. M. And you know, M is calculated as 1 plus real cost of capital. All right. Multiply by 1 plus general inflation rate or minus 1. That's the formula for money cost of capital. So M is equal to real cost of capital is 7.8%, which is 0.78. Multiplied by general inflation rate is 3%, or minus 1. So what do you have there? 1.078 multiplied by 1.03 equal minus 1 equal what you get?
11.034.
11.034%. So that's 11%. Rounding is approximately 11%. So let's go and post it there. You have to be very careful so that I don't give one belongs to Peter to Paul because you are too eager. Even though your cash flows, everything you are correct at the net cash flow, everything is correct. But if you don't convert that real cost of capital to money cost of capital, you are going to get it wrong. And that's why you have to be very careful. So here is 1. Yes, discount factor for year 1 at 11%, 9 point what? 0.9 what? Am I correct? 901?
Yes,
Oh yeah, now at 11%. 1.11 raised to power 1 minus equal, that's 9.01, 0.901. 1.11 raised to power 2 minus equal 0.812. 812. Then year 3, 1.11 raised to power 3 minus 0.731.
0.659.
659. Year 5.
0.593.
593. Thank you. So let's get the present value. Multiply to get the present value. Here is 140,000 minus PV, then MPV. Yes, year 1.
Sir, that year 5, I got 0.621. So can someone else confirm?
Okay. 1.11 raised to power 5 minus equal 0.593. It's 0.593. 0.593 multiplied by 12,053 equal. That's 7147. 7147. Right. Then 14,398 multiplied by 0.659 equal 9488. Then I have 57745 multiplied by 0.731 equal
37826.
42
216.
212.
212.
Yes,
Yeah, 10974.
1017974.
974.
10974. Okay. The second year, 87,603 multiplied by 0.812. 71,134. 71,134. Let's say 134, let me confirm. 71,134, yeah, correct. So at this point, you need to get the MPV.
955.
955. Here is 955. So that's that. Then we also have to compute internal rate of return. So number A2. Let me see, what did I use? A Roman figure 1, then A Roman figure 2. Calculating internal rate of return. So to get the internal rate of return, of course, all I need to do is to use my net cash flow that I've calculated under the MPV to calculate my internal rate of return. However, I'll be working towards using this 11% as my second discount rate. 11% produce positive MPV of 955,000. So I need to increase to 15%. So let's see, if 15% produce positive MPV, then I need to increase again to 20% to get a negative MPV. So assume 15%. So yeah, year 0, year 1, year 2, 3, 4, then year 5. Okay, so the net cash flow for the first year is year 0 is 140,000. Here is 12, 180, 87,603. A white student should go ahead and give me discount factor at 15% for each year before I ask. 57,745. Then 14,398. 12,053. So discount factor at 15%. Here
Year
will be
1,
one. Yes.
0.87.
870. 0.7 what for year 2?
0.756.
756.
Year 3, 0.656.
656.
658.
658 for year 3.
Yes.
Okay. Year 4.
0.572.
0.572. Yumi is not online again. She has disappeared, I think.
I'm here, sir.
She's still there. Some of you
5
have
is
disappeared.
0.497.
497. So let's multiply to get the present value. Here is 140,000 negative. Yes. Yeah. Pick it one by one.
10,597.
10,597.
For year
Year
3,
2.
37996.
37996. Year
Year
2 is what?
2. 662279 228.
228. Then year
8236. Year 4.
8236. Year 5.
5990.
5990. So add up the positive present value minus 140,000. What do you have as NPV? Yeah. What's NPV?
10,953.
10,953. Positive or negative?
Negative.
Negative. Okay. So in that case, we assume 15% it produces negative NPV of 10,953. So we are going to assume 11% as the second discount rate, which produce NPV of positive 955. At this point, we then calculate IRR, internal rate of return, equal to the lower discount rate is 11% plus the
11%.
NPV of the 11% is 955 over 955 plus NPV of the higher discount rate of 15%, which is 10,953. All of this multiplied by 15. IRR equal to 955 plus 10,953 equal 955 divided by answer equal multiplied by difference between 15 and 11, 4. Then plus 11. What do you have? That will be 11 point what? Yeah.
11.32.
11.32%. Okay,
Let me just
that's
reconfirm.
yeah, correct. Then the last requirements, in that requirement number A, you have to calculate discounted payback period. So when you are calculating discounted payback period, you are expected to use the present value to calculate your payback period. So I would say calculating discounted payback period. So to do this, we need the present, you need to discount the future cash flow to the present value equivalent before computing your discounted payback period. If you like, you can use the same columnar format or you turn into the normal format we use. So you can create a, if you want to use the normal format, you can create a column for year. So cash flow, no need for description of items, just say cash flow, then we have balance. Okay, we have balance. Your cash flow is the discounted cash flow, discounted present value. So 0, year 1, year 2, year 3, year 4, then year 5. Present value in the first year, based on the NPV we calculated originally, that's 10,974. Here is 140, 10,974. What about year 2? Present value, 71.
71134.
71134. Year 3.
42212.
122.
42212.
42212. Okay, year 4.
9488.
9488. Then year 5. Year 5 is 7147.
7147.
7147. So let's calculate the discounted payback period now. You can see that we did not use the normal cash flow. You have to use the discounted cash flow. We have converted the normal cash flow to discounted cash flow. Therefore, 140, bring out your calculator to say 140,000 minus 10,974 equal, oh sorry, multiply, I did multiplication. 140,000 minus
129026.
10,970. You said what? 129026.
129026.
Okay, 129026. So at the end of year 1, so you now minus 129026 minus 71,134. What you get?
57,892.
57,892 minus 42,212.
15680.
18,680.
680 minus 9488.
6,192.
192. You will notice that the outstanding balance of 6192 is lower than the next cash inflow of 7147. So you put a dash, then you calculate your discounted payback period. I would then say discounted payback period equal to how many years have I recovered? 4 years. 4 plus outstanding balance of 6192 over the next cash inflow of 7147. This will give us 4 point what?
Point 866.
4.87 years. So which means that using discounted payback period, this project will pay back within 5 years. All right. So that's that. Now, let's go back to the question. Requirement number B, on the basis of NPV, advise if the project should be considered. So number B, so you have to advise. Advise the project is financially viable, considering the positive NPV of 955,000 naira. Therefore, the project should be accepted. Okay. Then number C, examiner wants you to state all relevant assumptions. What are the assumptions you have made in the question? Okay, let me just list it for you. So assumptions. Assumption is not something you are going to fabricate. It's already in the question. How you come about your cash flow. There are some cash flow in the question you ignore. Why did you ignore it? So first thing first, whenever you want to state your assumption, you need to talk about cash flow. All right. However, you say that the calculation above is based on the following assumptions. Number 1, you talk about cash flow. Okay. Number 2, according to the question, we are given cost of capital, so you can talk about cost of capital. Number 3, according to the question, we're also given inflation. Then number 4, okay, Number 4, you can also talk about, of course, we have sunk costs. Okay, what do you mean by sunk costs? Okay, we talk about them. Any other assumption that you have made in the question, you need to talk about it. Under cash flow, what are you supposed to say? You know, in the question, we are given selling price, variable costs, incremental or attributable fixed costs. We are also given working capital. Our assumption is that the cash flow estimate, especially the sales value, the variable costs, the fixed costs, will occur at the end of each year. So you are going to say that under cash flow, you are going to say that the cash flow, it is assumed that the cash flow estimate will occur at the end of each year. All cash flow has been inflated at the appropriate inflation rate. That's all. Okay. So it is assumed that the cash flow estimates are realistic and will occur at the end of each year. All cash flows have been inflated at the appropriate inflation rate. That's how we did. That's how we treated the cash flow. Then under cost of capital, what are you supposed to say? We have calculated cost of capital of 11%. So what's our assumption on that? It is assumed that the cost of capital of 11% is consistent, is appropriate and consistent with the cash flows and the risk associated with the project. Remember, money cash flow for money cost of capital. So 11% is a money cost of capital. Our cash flow are money cash flow. Therefore, they are consistent. It is also assumed that the cost of capital of 11% is consistent with the risk associated with the project. Then number 3, talk about the inflation. What do you mean by inflation? It is assumed that the specific inflation rates given to all the elements that make up the project will remain constant within the relevant range. Okay, so because if you're, for example, if the inflation rate on the fixed costs or on the variable cost increases beyond what we have, the decision to accept the project may change. All right. So that's that. Just talk about the inflation. That's okay. It is assumed that the inflation rates given will remain constant within the relevant range. Otherwise, the decision to accept the project may change. Then number 4, you talk about sunk cost. What do you mean by sunk cost? According to the question, you are given development cost of 8 million. You are also given market survey cost of 2.5 million. Why did you ignore them? You then say that the development cost of 8 million naira and the market research cost, market survey cost of 2.5 million naira are sunk costs, are therefore ignored in this calculation. That's all you need to say as per your assumptions. If there are other assumptions that you have made in the question, then you need to talk about them. Okay? So that's it. That's the end of the question.
Please, I have
So
a question.
talk to me, please.
Please, I want to get the clarity about fixed cost that has depreciation in it and without depreciation, how we should treat it.
I said if you are given fixed cost, including depreciation, that fixed cost is irrelevant. However, you need to go and calculate annual depreciation and less it from the fixed cost. Whatever you have thereafter is relevant. Also, if you are given fixed cost, excluding depreciation, that fixed cost that excludes depreciation is relevant. You need to account for it. Yep. Is it clear now?
Yes, sir.
All right then. So any other questions so that we can close the class? We can't solve
Sorry, sir.
additional
Sorry, sir.
question today. Otherwise, we're
Please come again.
okay. Pastor,
Yeah, please come again concerning
come again
inflation.
where?
Concerning fixed cost and depreciation. You said the fixed cost
I've
to
said it
depreciation.
1,000 times. Okay. I said that if you are given inflation, there are 3 ways the examiner can, there are 3 ways the examiner can test you on fixed cost. If you are given fixed cost, no further information, no additional information. So that fixed cost is irrelevant because provided your fixed cost will not change, it is irrelevant. However, if you are given fixed cost, including depreciation, that fixed cost that include depreciation, I said, is irrelevant. However, you need to calculate annual depreciation and then less it from the fixed cost. Whatever you have thereafter is relevant. Then number 3, you may be given fixed cost excluding depreciation. So when you are given fixed cost that exclude depreciation, that fixed cost is relevant. You have to account for it. Okay? All right. So any other question, please? Any other question? Okay. So in the absence of no further question, this is where we are going to call it a day. Now,
Sorry,
next
sir.
class,
Sorry,
by the
sir.
grace of God, we are going to complete the question by solving additional 2 illustration. All right. And that will be all as far as capital budgeting is concerned. Yes, somebody is talking. Talk to me.
Sorry, sir. Please, concerning inflation, you said current rate. I want to know like when we should inflate as at year 1 and year 0.
Listen to the video now. Everything is explained. That means you have not listened to the video, right?
No,
Everything is there now. I said it when I was explaining the concept. I've also said it today. So when you listen to this video, you get it from there. All right? Pascal.
okay, sir. Okay, sir.
All right. Okay, guys. Bye-bye, everyone.
Thank you, sir. Good night,
Thank
sir.
you, sir.
Good night.